What if the chaos of Trump's tariff wars actually hides a deliberate economic strategy? For years, tariffs have been painted as blunt instruments, old school protectionism that hurts more than it helps. But under the surface, there is a theory, a plan. And if one takes a closer look at how the global trading system works, and more importantly, how it doesn't, it becomes clear that Trump's trade policy is rooted in a real and unresolved imbalance in the global economy. To understand this strategy, it is important to start with how global trade is supposed to function. In a textbook world, if one country imports too much and exports too little, its currency is expected to weaken. That makes its exports cheaper and imports more expensive, encouraging a natural rebalancing of currencies. Economists call this a trade equilibrium. The currency becomes the self correcting tool, like a thermostat, keeping trade flows in balance over time. But there's another force at play, financial flows. Investors move capital across borders looking for safe returns, and currencies respond to that demand too. This is known as a financial equilibrium. The problem arises when financial flows override trade financials, especially when a country's currency is used as the world's reserve. And that is the case with the US dollar. Because the dollar is the global reserve currency, there is constant demand for dollar assets, US Treasury bonds, for instance. Not because of trade needs, but because central banks and sovereign wealth funds want to park their money in a safe, liquid, and stable store of value. This reserve demand keeps the dollar permanently stronger than it would be based on trade alone. And that strong dollar makes US exports less competitive and imports cheaper, leading to persistent trade deficits. This situation is described by economists as the Triffin dilemma. To supply the world with reserve dollars, the US must run deficits. And that means consistently importing more than it exports, sending out IOUs in the form of bonds, and bringing in real goods. Over time, this pattern hollows out the domestic manufacturing base. Factories close, supply chains shift overseas, and certain communities, especially in the industrial Midwest, fall into long term economic decline. Trump's tariffs are aimed at breaking this pattern. In this first term, tariffs were imposed on hundreds of billions of dollars worth of Chinese goods. Now, critics predicted that inflation and economic disruption will take place. But something interesting happened. Inflation stayed low, GDP growth continued, and the Chinese yuan weakened by about 14%. That currency depreciation offset most of the price increase from tariffs. So, for American importers and consumers, the final prices barely changed. This mechanism, where the currency of the tariffed country weakens in response to tariffs, is called currency offset. It is a bit technical, but it is central to Trump's strategy. If the yuan drops in value just as tariffs grow up, the two effects cancel each other out in dollar terms. Goods cost the same in the US, but China earns less in real terms because its currency is worth less. And that is why Trump repeatedly said that China is paying for the tariffs. In this framework, he wasn't entirely wrong. So who really bears the cost? If currency offset happens, then it is the exporting country like China that loses purchasing power. The US collects the tariff revenue while the dollar price of imports stays relatively flat. If offset does not happen, then consumers in the US pay more. But even that outcome drives a deeper goal, which is to reconfigure supply chains. Companies start looking for alternative suppliers outside of China or even consider shifting production closer to home. This gradual nearshoring, moving production to Mexico, Central America, or parts of the US, is what the policy is really trying to trigger. Now, the political messaging around all this often focuses on jobs, bring back American manufacturing, create good paying jobs, etc. But there's reason to be skeptical that job creation is the core objective here. Since 2000, the US has lost over 5 million manufacturing jobs, and a significant portion of that loss was due to automation and not trade. Even when some manufacturing returns, it tends to be capital intensive and automated. Robots, not workers. Moreover, many of the tariffs were placed on intermediate goods, not final consumer products. And these are inputs used in assembly, not the kind of things made in American factories anymore. That suggests the real goal is not mass job creation, it is strategic, redirecting production away from adversarial economies and regaining leverage in trade negotiations. In fact, the bigger vision seems to be about rebalancing global power. Trump's team appears to believe that countries benefiting from US dollar dominance and military protection should contribute more, either by opening their markets to US exports or by paying tariffs. In his second term proposals, Trump has floated the idea of a 60% tariff on China and 10% universal tariff on the rest of the world. But implementation would not be immediate. More likely, it would be rolled out in stages with countries grouped into categories depending on how they align on trade, currency, and security issues. This bucketed approach turns tariffs into a tool for negotiation, not just over trade terms, but over geopolitical alignment. For example, countries that suppress their currency, violate intellectual property rights, or help China evade sanctions might face higher tariffs. Meanwhile, allies that support US security goals could face lower ones. The aim is not to rebuild every factory in America. It is to make access to the American consumer market a privilege tied to broader alignment with US interests. This all sounds strategic, but there are real risks. First, currency offset is not guaranteed. If markets don't adjust, import prices will rise and consumers will feel it. Second, targeted countries might retaliate, hurting American exporters or increasing geopolitical tensions. Third, financial markets could get jittery, especially if large devaluations in currencies like the yuan trigger capital flight or banking stress in those countries. And fourth, even if the policy works in theory, supply chains are incredibly complex. Disruptions, especially in tech, automotive, and healthcare, could ripple unpredictably. And finally, some allies may reject this approach outright, seeing it less as a strategy and more as economic coercion. Now, despite these risks, the logic behind Trump's trade strategy is more coherent than it is often given credit for. This is not just about predicting jobs or punishing China. It is about using two key levers, the dollar's global role and the US consumer market, to reshape the structure of international trade. Tariffs in this context become a form of leverage, not just to raise revenue, but to force a renegotiation of how the burdens of global finance and security are shared. Agree or disagree, it's not random, it is strategic. So, what do you think? Is this a bold attempt to rebalance a broken system, or is it a reckless economic brinkmanship that could backfire? Drop your thoughts in the comments. If you like this breakdown, hit like and subscribe, and join the Telegram group link below for more content like this. Thanks for watching.